Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. My goal is to help you put your money where your mouth is and invest in great companies. Now, if you are like me, you love food and you love investing. So, it only makes sense that you will love this channel too. In this video we will be exploring McDonald's and seeing if the world famous restaurant would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue that beautiful logo. Starting with the 1-year chart, we see that McDonald's had a CAGR of about 18.4%. Zooming out to the 5-year chart, we see that McDonald's had a CAGR of 11.5%. Very strong returns for so long. This is a classic blue chip company. Now, let's view the fundamentals. Gross margin is a very healthy 58%. Revenue has compounded at 3% over the past 5 years, most recently hitting $23 billion on a trailing 12-month basis. With this gross margin, that means that more than $13 billion is going on to operate the company every year. Whoa, just awesome. Looking at free cash flow, we see an 7% CAGR over the last 5 years. Capex has actually decreased at a CAGR of -7%, while stock-based compensation has increased at 6% CAGR, remaining steady with free cash flow growth. Free cash flow growth outpaces revenue growth, which points to a good capital efficiency. The shrinking capex is very good to see. This means that free cash flow should continue to improve. Stock-based compensation is so little compared to free cash flow that it is essentially negligible, and with it growing at the same rate as free cash flow, means that it should not become a problem in the future. Now, weighted average shares outstanding has been decreasing at CAGR of about -1.5%. I love to see companies buy back stock when the shares are underpriced. Coincidentally, if inflation returns to a 2% rate someday, then the rate of buybacks of McDonald's should almost negate the effects of inflation going forward. Next, return on invested capital. Return on invested capital decreased during the period at a CAGR of about -8%, falling from 29% in 2018 to 20% most recently. A return on invested capital of 20% is really good, but it is a little worrisome that this value is trending downwards. We will need to examine the cause of decreasing efficiency more closely. Another favorite metric is cash conversion cycle, a measure of operational efficiency at the company, going from a peak of 14 days in 2020 to 3 days most recently. McDonald's is demonstrating strong supplier leverage and inventory control. A negative cash conversion cycle, which would be the most ideal situation, means that a company's inventory is sold before they have to pay for it. Last, let's explore McDonald's debt metrics. For McDonald's, the current ratio is 1.5, the debt to equity ratio is 1, and the net debt to EBITDA ratio is 4.5. So now that we know all about the fundamentals of McDonald's, should it be added to the portfolio? Before sharing my final thoughts on that, please subscribe, like, and share this video. Your support means a lot to the Food Fund, and your continued viewership is a huge help to grow the channel. Now, let's get into my final thoughts. Okay, let's write out some key values for McDonald's. This popular restaurant has a gross margin of 58%. As mentioned in other videos, I like to start with gross margin because if this sucks, then no matter how great the other metrics, the company will be terrible. The 5-year revenue per share CAGR is 3% and the 5-year free cash flow per share CAGR is 7%. This shows that the company is growing very efficiently. This is really kind of amazing when you consider that McDonald's can only really raise prices and open more restaurants in previously unserved areas. They can add some regional food to menus, but they are not really developing new products. Every McDonald's serves French fries and burgers. A return on invested capital of 20% demonstrates good efficiency. I imagine the decline in return on invested capital was because of rising commodity prices and wages. Next, the cash conversion cycle of 3 is really nice. I would expect nothing less from this historic company. Concerning debt, a net debt to EBITDA of 4.5 is high in my opinion. It means the company would take over 4.5 years of EBITDA to pay off its debts. So from a fundamental standpoint, McDonald's is strong, but I would like return on invested capital to re-accelerate and for the company to get better control of their debt. Let's look at valuation. McDonald's is somewhat overvalued relative to the S&P 500 with a ratio of 1.5. As we have previously mentioned, strong fundamentals often command a premium to the market. The price to earnings growth, or PEG ratio, of 3.1 tells me that McDonald's may be also a bit expensive relative to its projected earnings growth. Last, let us review some recent McDonald's news to gain a better qualitative understanding of the company and some of its macroeconomic risks. A recent Seeking Alpha article explores the implications of the Supreme Court decision on student loan forgiveness. It is reported that analysts think the millions of borrowers who have yet to make a single student loan payment are at the most at risk of cutting back on some discretionary spending due to personal budget shock. Amid ongoing price inflation in the restaurant sector, there is rising anxiety restaurant sales could face a noticeable headwind in Q3 and Q4. Essentially, those monthly payments of hundreds of dollars will have to come from somewhere, and many believe discretionary spending will be the source. Many restaurants are expected to be impacted, particularly those in the fast food and fast casual space. In summary, McDonald's is a strong company, but there are some minor issues with return on invested capital and debt. Furthermore, the valuation does not scream buy at this point, and losing student loan forgiveness may be headwind in the midterm. Let's set it here on the watch list and see what other companies are out there. Many thanks for watching. What do you think about McDonald's in this analysis? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now, and don't forget to put your money where your mouth is.